I'm trying to go and see what kind of cheesy intro I'm gonna do. But anyway, hello one and all. Welcome to 1K to 1 mil in 1 year. Mainly today we are 3 weeks away from the first video that we did. On the first video, I believe, how much is it that we made the account? I believe in the first video. Do you guys remember? It was within a Monday. It was literally one trading day, and I believe that we had brought it to around 1,600 or something like that from $1,000.
Yeah, I think it was.
Yeah, I think it was around 1,600. And I did so many. After that, I have made so many mistakes because I was traveling. I was driving from where I was vacationing to back to LA. I was dealing with other work. I messed up on so many trades. And despite that, into last week, because last week, the 1 week that we missed, we were able to go ahead and turn the account to $3,000 by last Monday. No, actually we had it to less than that. What is it that we brought to last week? By this week, we've brought it to $3,000 so far. I believe that we got it up to 2,000 something, 2,000, right around 2,000 or 1,900. But let's go ahead and look at the trades that we had last week to give you an introduction into something that we could do once we got above $2,000. This is when we start doing a different kind of trading. So before we spoke about doing calls and puts, bullish, bearish, very, very simple trading. That's the only thing you can do when the account is below $1,000. Once we got above $2,000, we started having a little bit of flexibility. And mainly the big driver, even though I made so many bets that didn't work out, and so many bets that I didn't lock in. There was one bet that we got in that I could have made 400% profit. We didn't lock it in. We went bearish on NVIDIA. We were talking about how perfect that play was. I actually got out of my main account, but I did the same thing. I was not paying attention to the infinite account because sometimes it's difficult to go and think about the one that doesn't have the main money. I want to specifically focus on taking it as seriously as possible because that's the only way that I'm going to be able to turn this account from $1,000 to $1 million. No matter how talented I may be or how much experience I have as a trader, if I do not take this very seriously, it's already much more difficult to make money off of that account. We should have made that account last week into $4,000 from that $1,000 point. That is how much we missed on plays by me making mistakes. And I know Dash kicked ass on it, and Duke was able to kick ass on it. Duke, I see his empty seat. He was able to go and do very well on it. Let me go ahead and make sure that I have a full screen over here. Me, on the other hand, I did not make as much money as the people in the playground. But despite that, by Friday, we were able to bring the count. By Friday of the following week, we were able to bring it up to $3,000. That means a 300% profit in 3 weeks, which I don't think is bad. Now, how did we do this? First, we had a position that we were speaking about before that was into July. The reason why I'm talking about that call into July is 220. When we entered into that play, let's go ahead and look at the actual account. So you can see the screenshots over here. The July call, I know that it looks a little bit different right now inside of the screenshots that are in the playground. Now, inside of the playground, it's the same thing that you guys can see inside the chat room.
Mm-hmm.
When we entered into the 220 calls, by a singular position, just one position in 220 calls into July, how much do we pay for those calls when we entered? We entered at $2.50. On my main account, that option started working against us. I did additional accumulation, but that one account, that one position, remember, one option controls 100 shares of stock. So if I pay $2.50 for one option, that cost me $250. The reason why, let's go ahead and look at Tesla right here. And I know you guys can't see it over here, but once I've done the technical, Let's go and look at this on an hourly basis. When we were trading at as you can see over here, when we were trading at 160, even below that, I believe it was right around $150. I was buying 220 calls into July, and it seemed like an unlikely thing. But I knew that at some point we were going to beat and break out of this declining trend line that you can see has held up since September. So with this declining trend line, once we broke out of it, even though we broke out of it for a couple of days, we continue to go below it. Once we broke out of it, we're going to have a parabolic move. So that 220 position seemed like an impossibility. That's why we paid $2.50 for something that is so far out. And it lost practically half of its value, even more than that. But once we started breaking out through this level and we hit 186, everybody in the room, Dash, well, I don't know if it was Dash, but I remember that I had the conversation with you, Duke. You were asking me, you wanted to protect that position. And I told you, hold off, we're not at 220 yet. You remember that?
Yeah, I believe so.
Yeah, because we're up 100%, 200%, 300%. Whatever it is that we were up, it seemed like a huge number. Now, the thing is, how many days had we gained by then? By then, we had gained 3 to 4 days of continuation movement, which is more than usual for a continuation movement. So I continued to hold because I believed that we were going to have that continuation from that breakout. We had a pullback, of course, but then we had a continuation movement on the next move that never stopped. This move was parabolic. It just continued to go. So if I have the 225 calls and all of a sudden we move all the way to 220, when we hit 220, when the option got to that level, to that 220 level, that was when we needed to go ahead and start protecting. Why? Because we were 1 day away from the most amount of consecutive gains that we've ever seen Tesla have in its history, which I believe the most amount of days it ever had at that point was 9 days. Am I correct, Dash? Because I pointed it out to you. You were asking me why it is that we're doing what we're doing.
I think it might be 9 to 11 days.
Yeah, it was 11 days, and today was the 12th day on this run, so Tesla broke the record today. It tied it on Friday.
Okay, tied it on Friday, and the day before that, we were 1 or 2 days away. And let's go ahead and look at this from a daily perspective. As you can see, once we've gotten to this level, to right around 220 area, and today we broke that record of all time, I knew that we had to create a protection. Now, when we were right around this level, the way that I did a protection into the play is just like we bought a long option. You can short just like you can short stock. But I'm not going to short for that same week. I'm going to short for the next week. I'm not going to short for the same month, July. I could turn it into debit spread July, and then what that does is it slowly loses premium. But if I go with an in-the-money position or close to the money, if I would have gone at $2 and let's say 30 cents, it would have all been intrinsic value. Since we were above 220 at that point, and I shorted at 13 cents, my prediction was that there was a possibility that we could go back to that 209.46 area where you see this fib right here. So if I go ahead and look at it from from a perspective over here, this was a resistance point, and then we broke above it. I thought that we could go back to that 209 position. If that was to happen, if we had a pullback, that huge gain that we were seeing intraday on our July position would start eroding. But if for some reason we want to protect, but we don't want to get out of the position, but we want to have the equivalent of getting out of it for a short period of time. Think of this as Right now, I want to take off the risk for 1 week on that long position. Why do I want to do that? Because that infant account, everything was tied up. I needed to protect because everything was tied up on long positions in one direction or another. I couldn't do spreads yet, but now I got above the point where the account was above 2,000. So since the account was above 2,000, I could do what is called a debit spread. A debit spread means that you buy an option, let's say 220s, and you short an option that's further away, which would be like, let's say 230s. That's our traditional debit spread. But what the kind of debit spread that I did was a calendar on the exact same price point. So since I saw that we could, when we're at 220, we could pull back possibly to 209 because we've had so many days of consecutive gains, I needed to create protection, knowing that that would give me capital and that would allow me to put in additional bearish bets, because one contract that we shorted for next week, back then it was for the following week, we did one option short last week for this week that expires this week of 220 calls, and we did that at $13. And you can see it over here. Let's go in and look. You can see that we shorted it at, let me see. Yeah, we shorted it at $12.99. I don't know why it comes out like that. It was $13. Trust me on that. We were able to go ahead and get the mathematical point that I wanted. The reason why this is important is all of a sudden, all that risk of losing on our long terms, if we got stuck here and went back to 186, disappeared. No longer do we have that risk, because now we were guaranteeing for $13. And remember, one option, that one option that we paid $250, had gained a lot. It was right now. It was at that point probably worth something like, I would say, let's say $20. So $250 had turned into $2,000 practically. That short was $13. That means times 100, $1,300 that we could protect. And as soon as we created that short, we got back trading capital of $1,300. That gave us the ability to do additional trades. Now, what happened if we got stuck and we stayed at that level? At that 220 level or below? So if over here we stayed around this area, what would have happened with our play? Our play was making money. That short was making money for a little bit. Or maybe it was not. It doesn't matter. If we would have gotten stuck at 220 by this week, we would have collected $1,300 without any additional plays. One contract would have given us back $1,300. And remember how I tell you never to short because you have an unlimited amount of loss? This is different. It's protected by a long option. This is very similar to doing a covered call, for instance. It is similar to doing a covered call on stock, but we're doing it on options. And once we had that in, and we had a guarantee that if we went sideways, and we were just below 230, if we went sideways, would make $1,300 within 2 weeks, then we had flexibility. It was one contract, controls 100 shares of stock. So what did we do? We ended up getting into a position that was bigger for in case we went up. So the 235 butterfly became a possibility. It gave us the ability to go and create a butterfly at that higher point. So last week, we did something that is very different from a calendar, that is very different from a debit spread. So let's look back. A debit spread means you buy one contract and you sell a further out in-time contract. A calendar means that you have two different times of expiry. So we protected long term against a short that was that will expire at a closer date, which is this week, but we did this last week at $13. They cancel themselves out. They nullify each other. I took them off the game, off the board completely. I gave it a pause button on that 220 July call of a whole month. I gave it a pause button. Now comes into another strategy, which is called a butterfly. Butterfly means you buy a contract.
Real quick, can I just ask one quick question on the spread that we got there, the 220? Because it's also the 220 strikes. So that's the first time I've ever done that. We usually do debit spreads to where you know the max profit. So let's just say this does go to $300, right? And obviously that 220 short is, way, you lost a ton of money on it, but obviously you have the other 220 call. But is it still unlimited profit then? Because the 220 is further out in time, so it just has the theta is basically going to be your profit difference. Like if Tesla goes to $300, and you have to get out, you have to cover the 220 for June.
Okay, let's go and look at Tesla. So you're talking about it going to $300 by this week.
Yeah, let's just say if it did.
If it went to $300 by this week, then we better put in some additional plays. Now if it goes to 300, we are completely out of the game. We're completely out of the game on currently on the 250 calls, on the 220 calls. They are now completely off the map. So we would miss out on all that profit. So that is why we have to go and do other plays meanwhile. But if it happens within a week, the amount that we would make on a straight long singular contract that's in the money is nothing compared to what we can make on a straight long option that we can buy that's much cheaper, or a butterfly that's much cheaper, because we can buy many more contracts for a much cheaper price. You get me?
Right, yeah, but I'm just wondering,
we just miss out on the profits. The only thing that we do is miss out on the profits because it's off the table, except we do still profit. Whatever extrinsic value that option had. So let's say if it had $5 worth of extrinsic value, in the end, by Friday, that extrinsic value is going to be gone. So we gain that $500.
$300, you'd have $80 in intrinsic value that you'd have to cover, and then you would use it by selling the July, which would be worth more than $80.
But something that we're planning on doing on top of that, the reason why we have a butterfly that's very close by is I want to be able to keep one of those shorts to go against that existing long that we have now. So my focus is going to be able to go ahead and switch the short from one short to another. So we have a short at 260. So you're getting ahead of yourself. Let's go ahead and get to the next part of the strategy. If I take this off the table for 1 week, I have long terms off the table because what you wanted to do was lock in profits, right? But you wanted to do it at a lower point before we got to that 220 level. Once we were there, I had to go ahead and make a strategic decision. We are 1 to 2 days away from the most amount of consecutive gains this stock has ever seen. At that point in time, unfortunately, even though I said I believe that we're going to go to 247, that's where we had the next fib. So if we look over here, you can see 247 is exactly where we went. And we've gone back and forth on this point consistently. Why did we go to 247? Let's go and talk about the news. The first news was GM is adopting Tesla plugs, which are much better. I put a must-watch video that I hope everybody in the playground watched from 2-Bit Vinci. I'll also play that on the thing. That explains why this is a much better option and everybody should adopt it. Now, Tesla wants people to use their superchargers. So if they have any margins on that, they're going to profit because now everybody else doesn't have to create the infrastructure. I can drive from here to Chicago and back. I can drive into the mountains Everywhere that I go, Tesla has created an infrastructure that's worldwide of thousands and thousands of superchargers. Ford doesn't have this. GM doesn't have this. And everybody else that creates chargers, they don't have a seamless integration with software. It's terrible. These things work on a bad Windows thing that sometimes crashes. If you've ever tried to use any charging thing that's not Tesla, it's garbage. With a Tesla, you drive in and you plug it in and that's it. It automatically knows that my car's there. It has already paired with it. My phone is close by. It's done. So you guys will be able to do that with your Ford, because Ford introduced first. It was Ford. I'm sorry. Ford said that they were going to use the infrastructure that Tesla has. Then GM said they're going to do the same. They're going to use the same plugs, even if you have the older plug, you'll be able to today use their superchargers. This is good for GM, but it's great for Tesla, because Tesla now is where you go for all of your gassing up, electric gassing up, as for say. They now own the market. And if they're doing it, the biggest companies, it's going to force everybody else worldwide to try to go in the same direction. Because why would you? You're a car company. You don't know how to set up superchargers and how to maintain them and create the software and make it integrated and make it simple. Tesla already did that. All you have to do is focus on what you should be catching up on, is being able to create electric cars. So when GM came out with that news, we had this gap up that we see over here. So we went from that area where I think that the news was kind of leaked, and that's where we were going to all the way to 234 that day, and then we had the gap up on Friday. No, it wasn't Friday. Yeah, it was Friday, right? Friday or Thursday, whatever. Let's go and look at by days. Shows you how much I remember. 1, 2. Today's Monday. So yeah, Friday we had the gap up. So the news came out after market Thursday. Friday we have the gap up, and it pushes us into this new territory. The 247 that I said we should hit seemed very unlikely to hit within that same week. We get an explosion. Poof, we go there because of the news. What does that mean? We lose out completely and utterly on all that profit. Right? Don't we? Isn't that right? All the profit from July, we've already erased it. We're not going to make that additional profit. We're already locked in around the 220 area by creating a short on these options for this week. But we didn't. As soon as I had entered into that debit spread, it gave me the possibility of creating a butterfly. This is integral. Dash was saying, oh my God, look at all that money we missed out on. But Dash, are we really going to take that risk of not having any protection on in-the-money options? Because as they go deeper in the money, you think we're making more money, and we are, but we're losing extrinsic value. The deeper you go in the money, the less extrinsic value you're going to have, to the point where you have zero extrinsic value. That's your premium. That's the extra that it's. So let's say that we had this option trading at $17 before we got in the money. That was all extra value from the possibility of going in the money. Once we go in the money, for every dollar that we go up, we gain $1 in value, but we lose a little bit of that extrinsic value, of that premium. So I wanted to have something that will allow us to absorb premium faster. You hear me, Dash? Because that premium will go to zero. So even if we had $5 worth of extra premium, that's going to be extra money that's going to come in by Friday. So even though it has right now volatility of the people of extrinsic value, that will be completely gone by Friday. You hear me, Dash? Do you understand what I'm saying?
Yeah.
So with that completely gone, and us knowing that if we went down, we would profit huge, and we went sideways, we would bank like crazy. $1,300 within 1 week for an account that a couple of weeks ago was $1,000. We can make $1,300 just on sideways to down action. At that point, we already have the bearish case taken care of, plus We have the long term fully booked in. And now we have all this money on the sidelines that became available from creating that debit spread that we can put into additional positions because the account was tapped out with plays that lost, with all these bearish bets and all these other plays that made no money. I had so many 100% losers, yet still the account was up. I knew then, with 1 day to go, 2 days to go, 3 days to go, as soon as we got into the debit, that I wanted to create additional protection for in case we went up. So, how many contracts did we have on, let's go ahead and look in the playground. How many contracts did we have on the next butterfly? 235. We did a 235, we did actually several. We did a 215 put butterfly, bearishly, for in case we went down that week, because remember, we needed that premium decay to happen for 2 weeks. If we went back to 215, and that butterfly, by the way, was making money at one point, we entered it in at 49 cents, right? At the time of that screenshot, we were up a little bit on it. That one went up even more. When we got into that butterfly that you see over there on the put side, if we would have gone in, that was a butterfly of 2 contracts. So, let's say that we make $3 off of that play from 50 cents. That $3 that we put in, if we do 2 contracts at 50 cents, then we're spending $100 on it, right? If that goes to $3 of max profit, how much do we make, guys? 300 times 2, $600. We have additional profit potential there. Now, what if we go higher and we can no longer make money on that one play? Remember, for every $1 that goes up, that's just profits lost on our debit spread, on our calendar debit spread. So we created another butterfly. I got ahead of myself. I didn't explain what a butterfly is. As you can see, a butterfly is 1 to 2 short to 1. Let's say $5 spread apart. That means that your max profit is $5 if you get stuck right in the middle. You have a long, you have a double short, and you have a long. If it's calls, then, and it's always the same amount of distance in between if it's a balanced butterfly. So think about a body, twice as big, and then the wings. The wings have a certain width to them. It can be, if it's $5 away from one point, like let's say 230, 235, 240, that right there is a $5 butterfly, meaning the maximum that you can make is $5. If you make $3, be happy. Now, that put butterfly that we entered into bearishly, that one we paid 49 cents, so 50 cents. We had the possibility of, off of 2 contracts, making $600 off a $100 entry. Now, the same thing we did on the bullish side. So we created now a protection from movement down. We wanted additional profit driver if that happened last week. On the way up, above 230, because we're very close to 230, what's going to happen? We lose money, right? We're going to lose profits, not money. We're going to lose profits because now we're short the 220. Don't despair. We can do twice the amount of contracts on a butterfly that's above it. 230, 235, 240. If we spike up the next day, we can lock in our profit. If for some reason we would have gone just to 230, I would have locked it in right away. And I would have done an additional straight long for in case we went to 245. But the bottom line is, we had that, and we could make $600 if we went to 235. But what if we go all the way to my target? Remember, I'm saying 247, and I continue to say 247, and we had this long discussion in the playground. Look at the amount of days that we're going, but we should still go to 247. You guys remember that exchange that I had in the playground? Duke, you remember it, right? And I believe I tweeted it out as well. Are you guys there?
Yeah, he did.
You remember it too,
On mute.
right?
The motorcycles don't bother you.
Say what? I don't mind.
Oh, I
But
just have to mute it to make sure all the motorcycles outside don't
yeah, yeah.
don't bother you.
Do you remember that? Do you remember that day when I had that
And
exchange, explaining in the
exchange?
playground that we've gone up for a certain amount of time, we have to create protection, but I still believe that we should go to 247. So
Yeah.
when I spoke about that, I put in an additional butterfly. Now, how much do we pay for that butterfly? We already risked $200 in a week that are going to go to zero. Why can we afford to do that? Because now we have a spread that's going to make money on sideways action. So because we got into that short, we could now afford to throw money away on 2 butterflies, each $100 each, right? You know, the 235 actually we spent more on. So maybe it's that one we spent about $150. So right there, off the top of the head, we're already going to lose for sure if we go sideways. How much? $250. But we are willing to lose more. Because now, if we go sideways, we have $1,300 that we're going to make by next week. Because of that, I can do an additional bearish bet. And this bearish bet, I only spent $100 on. I bought 245. I don't know why it shows me 28 cents. That's probably including, you know, whatever has to do with commissions. We did a butterfly for in case we went all the way to that target. I was sure I was going to lose on this. I was sure after all these days that we're going to go and have a decline or we're going to go sideways. But if we do go to my target, because we've had so many straight days, we're at a historic point. If we do, I'm worth it. It's worth it to have that $100 position in there. And like you can see, I entered in at 28 cents and I was down $66. When we took that screenshot, it was worth 12 cents. Do you know what I did on the main account? We added. Do you know what the guy did in a new guy came to the playground? He's learning our strategies. He got in around 12 cents. He got into that play. Remember how I said the max profit is $5? How many contracts do we have? We have 4 contracts. So now, by creating, even though it's a small area, we can offset all the gains that we would have made off of that move on a much smaller move. Because now we're talking about controlling 400 shares of stock. Of a stock that's trading at 200 and whatever dollars. What does that? And the other guy, he got much more at $100. Let's say that you did at 12 cents. Let's go ahead and look at this from a mathematical point. So let's go ahead and get a little calculator. Well, hopefully, let's go ahead and look at it. $100 divided by 12, because it costs you $12. You get 8 contracts. Let's say that we get 9 contracts. Let's look at it over here. 9 contracts. And what is the current price of Tesla? Tesla. $250, right? More or less?
Mm-hmm.
Okay. So 9 times 900. He would get 9 contracts for his play. 900 times $250. He was controlling $225,000 worth of stock. Butterfly allows us to make the play super cheap. But we have to know when expiry is happening. And it's so difficult. I couldn't do butterflies back in the day because I wasn't as precise with my targets as I am today. Because they will slowly decay, but by the final day, they decay very quickly. He was controlling $225,000 and his account was a $1,000 account. But he only made the money in between that point of that gain. So what did he make? I think his account went to like 1,800, something like that. He had an 80% profit on a $100 investment in one day. Now us, we had less than that. We did many less. We did 4 contracts. So again, 400 times 250, we were only controlling $100,000 worth of stock. So what did that do? When we went within that level on Friday, when we went within that level of that butterfly, I told everybody to put your exits at least what price? You guys remember?
$3.
Right. And I said I had my position set where for exit. Do you remember?
350.
Exactly. 350 is a huge difference. So how much do we get out of that play? Per contract, we make $350, right? I was able to exit $350. Despite the fact that I lost out on that, I was able to make that additional bet. So I made $350 worth of bets that I was going to lose. Is that something that I could do in a $1,000 account? No. You can't justify that even on a $2,000 account that's going to expire in 2 days. That I can't justify that from a strategic point of view. But if I have $1,300 that I make on sideways action, I can now justify it. So Dash, do you see why it is that now, so even though we missed out on that gain, that was an unlikely gain on use that came out of nowhere. This gave us the ability to justify it.
That makes sense, and that answers my question from earlier too. So that all makes sense. And yeah, that 245 call butterfly that ended up working perfectly is totally against I think most people's natural reactions. When you take profit on something, you usually don't buy back into it until it dips again. Like I would have.
Exactly.
I would have taken my profit and been like, oh, okay, let me wait till the next red day.
Which is smart when you're doing stock. This is a level of